Namaskar dosto, welcome back to Dhwaj Stock Info. Today we are going to discuss one important subject, a topic is how to pick a winning stock with 7-point fundamental analysis framework. Let me show you two companies, company A and company B. Company A revenue growth is 35% last year, profit up 28%, debt is almost zero, return on equity is 22%, promoters own 65% of the company, and the stock is trading below the industrial PE. Then comes company B, revenue growth is just 8%, profits are flat, debt is 4 times the equity, return on equity is 6%, and the promoters have been steadily selling their own shares. Same stock market, same Nifty and same economy, two completely different companies. How do you identify company A before everyone else does and avoid company B before it destroys your capital? The next few minutes I'll give you the complete 7-point fundamental analysis framework. The same framework I refined over 30 years in commercial banking. Let us begin this video. In our short series, episode 5 to 11 and shorts 5 to 18, we built completely technical analysis system, 7 layers, candlesticks, RSI, MACD, Bollinger Bands, volume, support and resistance, moving averages. That system tells you when to buy and when to sell, but it does not tell you what to buy. Fundamental analysis fills that gap. Think of it this way: technical analysis is choosing the right moment to board a train. Fundamental analysis is choosing the right train. You can board exactly the right moment, but if the train is heading to the wrong destination, you are still on the wrong train. Today I give you the framework to choose the right train every single time, and with Nifty down 11% from its all-time high, quality fundamentally stocks are available at more reasonable prices than we have seen in last 18 months. This is the best time to learn the stock selection. I have spent 30 years in commercial banking evaluating business for lending and applied a postgraduate in data science from University of Texas at Austin to create a rigorous analysis framework. From all of that experience, I have distilled stock selection into 7 essential checkpoints. Every stock I consider must pass all the 7. Even if one fails, I move to the next company. There is 4,000 stock in NSE and BSE. You do not need to compromise. The first question I ask about any company is simple: is the business is growing? Revenue is the top line. Total money earned from the core business. Profit is what remains after all the costs. I need both growing consistently, not just one. Growing revenue with a falling profit means the company is spending more than it earns. Dangerous. Growing profit with flat revenue usually means cost cutting, not real growth. I want both growing for at least past 5 years. The screener in community filter confirms the sales growth 5 years above 15%, profit growth 5 years above 15%. Companies like Asian Paints, Bajaj Finance showed this pattern for the decades before becoming the extraordinary wealth creators. This is for educational purpose only. ROE is my single favorite member for the evaluating any business. It tells me how much profit is generated for every 100 rupees of the shareholders' money. If ROE is 22%, for every 100 I invest, the company earns 22 rupees of profit. Warren Buffett, the world's greatest investor, specifically looks at the companies with a consistent ROE above 15%. In India, consistency high ROE business appear in FMCG, private banking, insurance, and specifically chemicals. The key word is consistency. 1 year of high ROE means nothing. 5 years of high ROE means the business has genuine competitive advantage that competitors cannot easily replicate. Debt is the silent killer for the Indian companies. In 30 years of commercial banking, I have seen companies that looked excellent on the paper, growing revenue, reasonable profits, but were secretly drowning the debt. Debt amplifies profit in good times, but the bad times, rising interest rates, falling revenue, if it amplifies losses and destroys the company rapidly. The screener.in community recommends debt to equity below 0.6% of the equity stocks. I am comfortable up to 1.0% for the more sectors, but above 2, especially in the today's interest rate environment, I walk away without exception. Note, banks and NBFCs by nature carry higher debt. Compare within the sectors always. We covered this concept in episode 4 when learning to read annual reports. Let me remind you that most important lesson: profit can be manipulated but cash cannot be. A company can show beautiful profit using accounting techniques, recognizing revenue before it is actually received, delaying expenses recognition, aggressive depreciation policies, but operating cash flow is the brutal ground reality. If a company reports 100 rupees core profit but operating cash flow is negative, something is fundamentally wrong. The business is not generating the real cash deposit to the profit figures. TCS and Infosys consistently generate operating cash flows that exceeded their reported profits. That is the gold standard I look for. Investors completely ignore, and it is the one of the most powerful signals available in the Indian market. Promoters holding tells you how much the company, the founders themselves still own. If the promoters hold 65%, they have an enormous amount of skin in the game. If the personal wealth is directly tied to the company's success, they are deeply motivated to perform. If promoters are steadily selling their own shares, ask yourself one simple question: who knows the business better than the founder? Nobody. If they are exiting, they are seeing something that the public cannot see it. And if the promoters have pledged their shares as a collateral for the personal loans, that is the extreme red flag. Pledged shares can trigger a forced selling that crashes the stock market dramatically and suddenly. We covered the PE ratio in depth in short 2, but here is I use specifically in stock selection. The PE ratio tells me how much the market is paying for every rupee of annual profit. The screener.in community filters confirms PE below industry average. PE is the key criteria for the quality stocks. I do not avoid high PE companies entirely. Genuinely fast growing business can deserve higher PEs, but I always compare the PE to the growth rate. If a company grows at 25% per year and the PE is 35, is reasonable. That is what the investors call grab, growth at a reasonable price. If PE is 80 and the growth is only 12%, I walk away with Nifty down 11% from all-time high in May 2026. Many quality businesses are now trading at a PE ratio not seen in the 18 months. This is exactly the moment to look at. This is the most qualification of the 7-point and arguably the most important of all. Warren Buffett calls it as a moat, the comprehensive advantage that protects the business from well-founded companies. A company with a genuine moat can maintain a high ROE, a consistent profit growth and a pricing power for the decades. In India, HDFC Bank has the trust moat built over the 30 years and no new bank can implicate quickly. Asian Paints has a distribution moat reaching 70,000 dealers across India. Page Industries has brand moat through the exclusive jockey license. The moats are extremely difficult for any competitors to replicate, no matter how much money they have. Before investing the money, the company asks yourself honestly, what prevents a well-funded competitor from taking their customers tomorrow? The answer is to that question is moat. If the answer is nothing, moves on. Here is your practical step-by-step workflow.
Friends, I'll show you step by step how to search a stock in a screener.in. It is completely free. We'll go step by step and it covers all the Indian stocks. Start by setting these filters criteria in the screener. Create a screen page. Here if you type screener.in Google browser, this screen will appear. Then go to screens. Here you will have various themes. Accordingly you can select any screen and you can research on this freely. Now I will show you how to create a query here. Create a new screen. If you click on this, this box will appear. Here we will see sales growth for the past year, 5 years. It should be always more than 15%, and profit growth, we shall see profit growth for the past 5 years. This should also be more than 15%. And then debt to equity ratio, this should be less than 0.6 always. And finally we'll see profit to earning ratio should be less than industrial average always. If you do this query, industrial PE, if you run this query, this will appear. All this it will select so many companies as per our criteria. You can see these and select your stock accordingly. For example, I show you one Kesals India. If you click on Kesals India here individually, it will give in the first screen, it will give the it will give the summary of the stock, market capitalization, current price, stock PE, book value, everything. If you still go down, you will get the price movement for that month. Then the peer comparison is there. Here the TCS is the lowest PE and Kesals is having the 20 more than 20. Kesals PE is 20.25%. So check all these points. 5-year sales growth and trend summary page you have seen. Point number 1. Step number 2, ratio screen, ROE and debt to equity ratio trend. Here you can see the ROCE. And step number 2, point number 2 and 3 is done. Step number 3, cash flow tab. If you go to cash flow, here quarterly results are there, then profit and loss is there, then balance sheet is there. Here then the cash flow is there. You see that cash flow, operating cash flow is positive and growing. Point number 4 is done. Then step 5, current PE versus the last 5 years PE. If you still go down, you can see the ratios here debtor days, insights, then shareholding patterns. Shareholding patterns, promoter percentage is 58.52, DI, FI and public percentage, everything is available here. Point number 6 is done. Then go to the annual report section, see last 2 years management discussion analysis. Point 7 is done. Total time per stock should be less than 15 to 20 minutes. And if all the 7 criteria passes, then this stock deserves further analysis.
Your action plan for today: 4 steps. Step 1, open screener.in right now. It is completely free. Go to the screen, create screen and set these 4 filters: sales growth 5 years and above, 1.15% profit growth 5% above 15%, debt to equity ratio below 0.6%. I have shown you earlier. PE below industrial average PE. Run the screen, you will see the short list immediately. Step 2, pick any one of the company from the list, run it through all the 7 points using the workflow I just showed you. Step 3, it is passes all 7 book market. Research it deeper using the annual report skills from the episode 4. Step 4, if it fails even 1 point, move on without emotion. There is 4,000 stocks. You do not need to compromise on the quality. Comment below and tell me which company you are running through the 7-point framework today and how many of the 7 points does it pass. I read and reply to every single comment every day. This is the framework helped you. Please share with one friend who is investing based on the tips rather than research. You could genuinely change their financial future. See you episode in 12 where we go even deeper into the balance sheet. This video is for only educational purpose only, and please research more before taking any decision. Please subscribe, please like, please share and write your feedback in the comments. Thanks for watching.